Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is your host, Jason Hartman. This is episode number 517. 517. Thank you so much for joining me today. I am coming to you from beautiful Dubrovnik, Croatia. Yes, it's my second time here. I actually talked to you on the show from here before. I remember it distinctly, just about 2 years ago on my last visit. And it's great to be back here. This is really a beautiful place. It's not super easy to get to, though. You know, it's not a major European hub. It was for a long time kind of this undiscovered place, you know, the beautiful Dalmatian coast. And when it first began to get more popular as the climate became more peaceful, there's been a lot of conflict in this area. You probably know that all too well. And I remember reading a lot about it in all of these international and offshore real estate investing newsletters that I get and got back then years ago. And I really wanted to check it out. And I actually came here 2 years ago to look at properties. And once again, I just got to tell you, a friend of mine here on this trip with us today was asking me, he's rented a place in London for 2 months, and he's asked me about investing in European real estate. And this stuff, it sounds sexy, but so far, and as of yesterday, I went to my 76th country. Yes, that was Bosnia, by the way. I went over to Bosnia-Herzegovina yesterday and took a rather long day trip there. It's right next door to us here in Croatia. And, you know, in looking all around the world, I tell you, the American real estate market is really special. We have definitely talked with local market specialists. We're still going to call them that. We'll call them the LMS, the local market specialist, by the same name in many, many parts of the world, from Australia to many South American and Central American countries to several European countries, even in China. And I tell you, American real estate is pretty special, okay, for many, many reasons, not the least of which is, you know, of course, and I've talked about this before, it's been subsidized by the government since the Great Depression. You know, we have this very mature, as corrupt as it is, banking and mortgage market, the secondary mortgage market. And of course, I'm referring to Fannie Mae and Freddie Mac, but also, you know, in the U.S., you know, that's really the only major country that has a really good multiple listing service, an MLS, not to be confused with an LMS, a local market specialist. I know those two could be confusing, but the MLS system in the United States is very, very mature. And in all of these foreign countries around the world, pretty much, I know there are inklings of MLS systems in many countries, but it's just not like it is in the US, okay? Most of the business is this sort of off-plan, it's called many times, off-plan development and off-plan deals. And, you know, you just don't have good data. I mean, let's even forget about the multiple listing service, the MLS, for a moment. Let's just talk about these highly developed, very old county recording systems. And they are kind of primitive as you look around the U.S. You know, many of them are very different. And But you have data, you have pricing data in the US, and you just don't have that around the world. You certainly don't have Zillow, you don't have Trulia with all of their flaws, you don't have Realtor.com with all of its flaws. But, given all of that, the pricing data in the United States is so much better. It is so much better than it is around the world. And that makes me feel that the U.S. market is much safer. Now, let's throw all of that I just said out the window, and let's talk about something else. The prices are lower in the United States. You can't buy a decent property in any... Now, I could be wrong on this, but I'm just going to throw it out there, okay? I do not have total facts. I just want you to know this might be a reckless comment slightly, so I am making that disclaimer. Please feel free to call me out on it, okay? But I'm just going to say that you can't buy a decent quality property comparable to the types of properties you can find at jasonhartman.com in the properties section in any European capital city for $100 a square foot. And I'm going to go not just one step further, I'm going to go 2 steps further. I'm going to say that you can't even buy a comparable property to what you'll find at jasonhartman.com in any second-tier European city for $100 a square foot. And wait a moment, okay? Someone may well call me out on this. I just, I'm taking a bit of a risk here, okay? I don't think you can find a comparable property in a third-tier European city for $100 a square foot. And of course, you can go to jasonhartman.com and you can find these properties for quite a bit less than $100 a square foot. All right? So the properties are just less expensive in America. And why is that? Well, it's because the building industry is more developed and more mature, and the supply chains are more developed and more mature. So all of that, now let's throw all of that out the window. Let's throw out that we've got a mature banking system and a mature mortgage market and the best mortgage financing in the world. I didn't even mention that one yet. And let's throw out the fact that we've got the best quality of data in the world. And let's throw out the fact that we've got the cooperating real estate system through the MLS that really, Canada. I'll make an exception for Canada, and there's a few inklings of others around the world, but really, it's not like it is in the U.S., okay?
Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
Even in Canada, it's not quite there, okay, in that way. We've got these cooperation system among different real estate licensees where the vast majority of them have to cooperate to sell properties through their association of realtors and their multiple listing service. Let's throw all of that out and let's just talk about rule of law and corruption and standardized practices, okay? And all of that is, I know there's some other great places around the world for sure. I love to travel. I was not born in the United States. I was born in Europe, okay? And I love coming here. But I just think the U.S. has a very unique real estate market. It is a really pretty special real estate investment market. So I think it's much better. And believe me, if I thought it made sense to be investing around the world, I would be doing it. I would set up deals with local market specialists in markets that I'd recommend, and we would be recommending them to you on this show. And this all could change in the future, but so far in the past, really 11 plus years of me being in the nationwide real estate business, I haven't found anything that even comes close to the United States real estate market. So that's my thought. So yesterday I visited Bosnia-Herzegovina. wow, what a beautiful coastline. I mean, of course, the Dalmatian coast here in Croatia is just stunning. It's spectacular. Beautiful, beautiful place. We talk a lot about currency exchange rates and inflation and so forth. And yesterday I was talking with a couple of my guides as they were showing me around Bosnia, and they were talking about one of them was Croatian, and she was talking about how high the taxes are in, all of these places. They basically take half of your income, and just how hard it is to get ahead. And admittedly, maybe that's getting harder in the U.S. I certainly have my complaints, but just the economic opportunity, too, is another thing that's huge. But nonetheless, beautiful, beautiful place. Really interesting, some of the stuff I saw yesterday, and I'll try to talk about that on another show. But I've got a bunch of listener questions I want to get to, and I want to make sure I get to those for you. So first of all, a couple shout outs to our listeners. First of all, Marge, thank you for sending me the link about the $150 house. I've seen things like this before. You do an essay contest, you send in $150 to enter, you get 1,000 people to enter, and suddenly you've got $150,000 and a bunch of essays to read. Maybe you don't even read them all, I don't know. And then you give someone a house and say they're the winner. It's a great publicity stunt. Actually thought about doing it myself. Maybe someday we will. But anyway, it's an interesting gimmick. It's an innovative idea for sure. Roger, you asked a good question, and you were listening to the Flashback Friday episode recently where maybe it wasn't a Flashback Friday. Maybe it was just a prior episode, where we talked about the next 10 commandments of successful investing. Yes, I started with 10, then I added 10 more. I thought about adding another 10 and, having 30 commandments, but I don't want to make it all too confusing anyway. There are more commandments because, there's more to it, right? Anyway, number 11, thou shalt not be a sucker. And I'm reading what you wrote me here, by the way. I'm not reading it from my own content. So, assuming you got it all exactly as I did it. Thou shalt hold thy tenants accountable. Number 13, thou shalt understand the theory of relativity. And number 14, you said you didn't catch it in that prior podcast. So here it is for you. You ready? Okay, Roger, here we go. Commandment number 14. Thou shalt benefit from Mother Nature, Father Time, and socialism. Well, what do I mean? As real estate investors, I say, look, we are finally on the right side of all the things that most people complain about, or at least most people paying attention who are thinking about it complain about these things. Most of these things are considered bad, right? So Mother Nature. What does Mother Nature do? Mother Nature gets angry sometimes and causes disasters, and that puts upward pressure on commodity prices, and we are packaged commodity investors. We are assembled commodity investors. If you don't know what I mean by that, go to jasonhartman.com, use the little search bar in the upper left, and type in packaged commodity investing, and you'll find all sorts of references in my blog post and in prior episodes and the transcripts about it. And that puts upward pressure on the prices of these commodities that are the ingredients to the properties, the houses and apartments in which we invest. So that's great. How about Father Time? Well, most people bemoan the passing of time. Aging is not a terribly popular idea. Most people like youth, and, you kind of got to surrender a lot of the great things about youth as you age. One of the great things about aging, though, is wisdom and perspective, and I just love that with each passing year. I'm sure all of you listening do as well, but, couple of gray hairs are starting to show up, and Obama told me there's no recession yet. I don't know. I look at my hairline and, I think there is one. But a few more wrinkles of wisdom here and there. But Father Time is great for the real estate investor because as we invest in real estate, we put time on our side. I don't need to explain too much about that because, we talk about it all the time, right? How time benefits us as investors. But what about socialism? Most productive people, most thinking people who are earning their keep and not leeching off the system, they don't like socialism. The people who feel generally insecure about their ability to produce and provide and earn a living, and maybe aren't that motivated, and like to kind of kick back and relax and have the big social safety net and so forth. Those people, they benefit from it, but the productive class, people in Ayn Rand's book, and by the way, we got a really interesting show coming up. It's going to be on the Jet Setter show. I might even play it on the Creating Wealth show about foreign investing. Kathy, by the way, I did a really interesting interview with a guy that you referred. So Kathy, one of our listeners, referred him, and it's about this development called Galt's Gulch, turned into a big scandal in Chile, South America. But that'll definitely be on my Jet Setter show. I might play it on the Creating Wealth show too. It was a pretty fascinating thing. But the John Galt ideology, right, in Ayn Rand's excellent book, Atlas Shrugged, about the productive class just going on strike at some point, right? But socialism, as real estate investors, really, it does benefit us. Why? Because when the government becomes irresponsible, when they spend too much, it creates inflationary pressures, and it also creates things like Section 8 housing and freeloading renters who get the rent paid by the government. And a lot of investors specialize in that type of renter. Some love it, some hate it. We've talked about that many times. But ultimately, government spending creates inflation. So, commandment number 14, thou shalt benefit from Mother Nature, Father Time, and socialism. All right, so there you go. Thanks for asking the question, Roger, and that is your answer. Now, Hannah also had asked a question before about private lending and hard money lending, and again, she said, I've got $150,000, $200,000 maybe that I want to lend, and I think she owns some good real estate properties, if I recall correctly. She wants to do some lending too. And, the lending, again, is not as good as actually owning the property, but it is simpler and it's just a different kind of thing. You might want to diversify, do a little bit of both. The lending is a little bit hard. It's getting a little bit competitive. The rates have been driven down a bit. There's more competition amongst lenders and fewer borrowers, or at least borrowers that are getting their needs satisfied for borrowing. And so the rates have declined a little bit. But to answer your question, Hannah, really, if you have about $75,000 or more, you can get into the lending game with us, and we can refer you people. And I already know I referred people to you, so you're already talking to them. And then we've got my favorite way to take a question. Please use this, and that is our voicemail system at jasonhartman.com. So here's a great question from Pam.
Hi, Jason. I have a quick question for you. Your last podcast, you interviewed one of your clients, and he said he bought his properties with cash and then did a cash out refi. That seemed like a terrific idea because it seems like the rates are much better if you do a cash out refi. And I just wanted to know if you could speak to that. Thank you. Your podcasts are great, and I appreciate everything you do.
Okay, so Pam, first of all, thank you for the kind words, and that's a great question. And of course, you're talking to a guy who loves leverage, properly used leverage, of course, but cash out refi is a phenomenal plan. Some, including myself, call it equity stripping. You've heard me talk about the refi till you die plan, which is an excellent game plan as a way to extract wealth from your properties. But cash out refi rates are not necessarily lower at all. You may have been saying that just because the client might have mentioned that when they bought the properties, they had a higher rate and rates overall declined. And then they did a cash out refi and happened to take advantage of a lower rate. But they're not going to be lower in the same time frame if you're comparing apples to apples that way. But still, I think the cash out refi is an excellent thing to do. In fact, I would do it whenever possible, whenever it makes sense. when it makes sense is sort of a complex question because it depends on how much equity you have and what you're going to do with the money. Hopefully you're going to buy more properties. And this really is the great thing, well, one of the many great things about income property investing is that, we don't pay our own debts. We outsource our debts to our tenants. And so our debt becomes a self-liquidating debt. That's a term you really want to keep in mind. A self-liquidating debt. Self-liquidating debt. Remember that one. It's a good term. So when we do a cash out refi, one of the great things that we get to do with our properties, and it may take a little bit of time because you have to build up some equity in the property first, but many times you can acquire the property, let it appreciate a little bit, let a little bit of mortgage pay down happen. You do a cash out refi, you could get all of the money you put into the property back. So you've now got zero in the deal, yet you still have the asset. You still own the property. And even after a cash out refi, the property could still potentially perform at a break even or a positive cash flow. So income property has very special, wonderful characteristics, and it is the most historically proven asset class in the world. Remember, I used to just say in the United States, if not the entire world, but I'm going with the entire world. Okay? So that's what I'm doing. Anyway, hey, this intro, as usual, has gone a little long. Let's get to our guest, Gary Carmell, as we talk about the philosophical investor transforming wisdom into wealth. It's my pleasure to welcome Gary Carmell to the show. He is president of CWS Capital Partners. He's author of The Philosophical Investor, Transforming Wisdom into Wealth. Gary, welcome. How are you?
I'm doing great, Jason. Thank you so much for having me.
Good to have you on the show. I was going to turn that title around and say transforming wealth into wisdom, which is unfortunately the way it goes for so many investors, right?
That is great, yes. I think there's an old Wall Street adage that says something like, if you're unwilling to change your mind, you'll have no change to mind. So it's
There's a lot of quotes around this. One is, experience is the best teacher. Unfortunately, you can't get the lesson until you get the experience or something. I can't remember it, but, it kind of goes along those same lines.
Yeah, no, I mean, it's like, what the wise do at the beginning, the fools do at the end, or something like that. So.
Yeah, exactly. Yeah. A fool and his money are soon parted. Boy, we could have cliches for many minutes. One I'll tell you is that you might really want to comment on is, what happens when a general partner and a limited partner meet. At the beginning of that relationship, the general partner has all the experience and no money. The limited partner has the money and no experience. At the end, they change places.
Sadly, that's true. And, we are in the business of being a general partner, and there is no greater responsibility and honor than the trust and fiduciary requirements you have to manage other people's money. And it really upsets me when I see that violated. And, we've been in business since 1969 and cultivated just many, many wonderful individual investor relationships over the years. And you have to be a trustworthy, credible firm built on integrity, values, and deliver results.
Yeah.
So
there's a lot of bad apples out there, certainly. In fact, I just saw one in the paper yesterday. I can't remember the story, but this was a trader, like a Wall Street trader, taking off with a bunch of money. These are cliche. I mean, it's almost one scandal a day on Wall Street. Which is why I like real estate better for sure. But tell us a little bit about the philosophical investor, if you would, and what is the sort of the thesis behind it, if you will?
Yeah, essentially, I don't think it's a big surprise for people that are students of investing, but I've seen the enemy and it's in the mirror. So it's oftentimes ourselves. And what I have found is essentially it's very hard to overcome human nature that is susceptible to bouts of fear and greed. And oftentimes we do the suboptimal thing. And if you kind of look at the average investor return versus different asset classes, they tremendously underperform because they go in at the top and sell at the bottom. And so a philosophical investor to me is someone that learns from others, people like Warren Buffett, Charlie Munger, George Soros, even Shakespeare, and I even tap into some musicians and artists and philosophers, and then you learn from yourself. And at the end of the day, what you try to do is marry the seminal experiences in your life from the wisdom that has been conveyed by others in a way that hopefully, like Odysseus did, you can tie yourself to the mast and avoid those really terrible decisions.
The siren song.
And so, so that at the end of the day, and I would say one of the great quotes in the book is from a philosopher, Schopenhauer, German philosopher, and he said, the task at hand is not to see what no one else sees, but to think what no one else thinks about that which everyone sees. So how do you prepare yourself to think very independently and control your emotions and make good decisions?
That's such a good point. There's so much psychology to it. We are our own worst enemy. We've met the enemy and the enemy is us. Boy, we're full of cliches today, aren't we? Don't worry, listeners. We won't do that the whole episode, okay? I promise. But this really happens, the most toward the end of a bull market in anything. And maybe that's what's going on in the stock market right now. The tips from the shoe shine boy type thing where people, it's just so tempting when you see all of these people around you, and you hear all of these stories about these big capital gains. Right now, you're in my old hometown, you're in Orange County, California. I mean, you look at the real estate market in there and in other high price cyclical markets. I mean, prices have been going crazy the last couple of years. And I used to play in that game. And now being a little older, wiser, more conservative, I just like the cash flow markets, where properties appreciate in a more linear fashion and they just cash flow. So, they're susceptible somewhat to the economic ups and downs, but it's not a major swing. I'm not investing for appreciation. But that is the really tempting story, isn't it? Whether it be stocks, real estate, gold, Bitcoin, anything, right?
Right. Especially, like you alluded to, when you hear about others doing well and you have the sense that maybe you're falling behind, you're so susceptible to want to jump in with the fray. And I think if you take a step back, respond, and reflect rather than react, you develop certain investing cardinals, like you mentioned about cash flow. At least cash flow is a metric that can allow you to value assets sort of within a relevant range. You don't have to use your imagination so much. And so I think kind of sticking to things that you feel comfortable with, that have worked for you and you believe will continue to work, I think that makes a lot of sense.
I love the way you said that. Sticking with things where you don't have to use your imagination. Like your imagination says, oh my gosh, I'm going to make 30% in capital appreciation on this deal in a year. That's not sustainable. I mean, can't we learn from history? Where everybody's susceptible to it, aren't they?
Yeah, and that's where the opportunity is too. If you can recognize those bouts of collective madness, and I like to say monetizing the madness, and stay out of the fray when everyone's going crazy and jump in when there's a lot of fear and despair, then one can really prosper. So, but we really do have to check ourselves to stay out of it when it gets crazy.
Yeah, we certainly do. Hey, tell us about the Munger moment. Munger is Warren Buffett's number 2 man, right?
Yeah, he is such a brilliant man, and at 90 or 91, he continues to just produce incredible thinking and investment results. And so there was something he said. He was describing a situation where they avoided a problem which everyone else fell prey to. And what happened was there was so much carnage that they had money and courage to step in when others didn't. And what he said was there are these very few opportunities that present themselves in one's life. But if they're recognized as such, where you, through analysis and using different variables and looking at the world sort of holistically and comprehensively, you can determine that the odds are overwhelmingly in your favor, then all you need is the courage and the capital to take advantage of that opportunity, and that capital has been generated because of patience and prudence in the past. So when everyone was jumping in and you stayed out of the fray, they lost money, you kept your money, now you have one of these moments that I call a Munger moment. And they don't happen all the time. They're very few and far between. But when they occur, in the words of George Soros, you go for the jugular and you really load the boat, and it can make a huge difference in one's life, financial outcomes in their life.
Can you give us an example of that?
I can. So our business, we own, operate, build apartment communities around the country. We have about 23,000 units or so, worth about $3 billion. So that's our business. So in the aftermath of the subprime debacle, we had seen there was so much excess going into housing finance that we kept saying that people are renters, but they don't know it because they started owning homes with no money down. And once those homes started losing value, they had negative equity. They basically were renting the homes from the bank. And we knew this was going to turn into a big problem, and that when we hit the recession, almost a near global depression, our indicators and way of looking at the world told us that renting was going to be not only, it was going to be necessary in the only form of new household formations, because no single-family housing essentially was being built. You couldn't get mortgage credit, and yet people needed to form new households, and they needed to build and rebuild their credit, and they could do this through renting. And they had the flexibility to go where the jobs were. So that to us was a Munger moment. We said, we aren't going to see conditions like this for a very, very long time that are going to be so favorable to owning income-oriented apartment communities, because the supply was contracting. And even though the demand was down, once the economy started to recover, the demand would explode and there would be a tremendous imbalance. And our thesis has generally turned out to be correct.
Okay, so in hindsight, you were correct. But here's the problem. Just like, in any cycle, if we're looking at this graph and what we're mostly talking about here, I by the way, you may not know this, but I differentiate real estate markets into three types. The linear market, that's the market that just sort of chugs along and does its thing, averages 5-6% appreciation annually over time. Then there's the cyclical market, that would be, pretty much all of California, any high land value area, South Florida, the Northeast, those types of markets are cyclical. They have big swings. You catch them right, you can make a fortune. You catch them wrong, you're dead. Okay.
Yeah, I call those high beta markets.
Yeah. High volatility, high beta markets, sure. And then there's the hybrid markets. And, Phoenix would be a hybrid market where, it kind of acted in a linear fashion for decades. And then in the last go round, when we saw all this California money flowing into Phoenix and Nevada, or Las Vegas and Phoenix, I do know the difference between cities and states, by the way. Those markets became really cyclical and really nutty, just as California did. And, in these different types of markets, the problem is when you're in the doldrums, when you're in that trough, you don't know that that's the bottom. Nobody does, right? And it's sort of easy to say now, looking back, gosh, we scooped up a bunch of deals, in the worst part when all the news was bad and so forth. But how do you know when you're there? After things went, depreciated by 30-40%, sure, great deal. But how did you know they wouldn't go down another 10 or 20% beyond that, right?
Yeah, that's a very, very important, question and, shrewd insight. And one of the reasons I wrote the book, or one of the things I convey in the book, is that in my career at CWS, which has spanned nearly 30 years, I've been a fairly consistent writer of letters to our investors over particularly the last 15 years. And when I read investment books, just like you're saying, hindsight, is 20/20, of course. But what were people thinking in the moment? And the book conveys a lot of our thinking in the moment about how we were looking at the world, because it was a deep, dark time. There was a lot of fear and despair, and you didn't know if the light was the train coming at you or the light at the end of the tunnel. And so, what were going to happen to multiples for real estate? Were they going to expand dramatically because the capital had exited? So we went through a lot of this thinking, and basically, I went back and tried to draw parallels to the 1920s and 30s and see how values responded back then. We looked at indicators. So by doing that, I actually got a level of comfort. I even looked at valuations of New York real estate in 1932, 33, 34, and they were very similar in their cap rates as to what they are today, and they didn't move much. So I thought that, okay, this is the depths of the Depression. Valuations actually held up okay. But what we saw was a dramatic drop in transaction volume. You know, most people didn't sell. You didn't have the distress from the banks forcing foreclosures. So we then took a step back and said, one of the metrics we wanted to look at was replacement cost. You know, can we buy properties below replacement cost? And that gave us a level of comfort that we couldn't see much new supply until rents were significantly higher. So that was kind of check the box there. We were able to borrow at rates that offered us positive leverage. So we could buy a property at a 5 or 6% yield and borrow at 3%. And we felt like there, you know, you were talking about cash flow, that felt pretty safe to us. So even if we overpaid a little bit in the first couple of years, we could kind of earn our way out. And there was such pessimism there, and there was no new supply of apartments because the banks were cutting back and they weren't lending to developers. So we just felt like there was the margin of safety was evolving, and the risk reward was so favorable. So you don't always know, of course, but we kind of put this mosaic together and said the odds were surely in our favor.
That makes sense to me. Now, let's talk about replacement cost issue for a moment, and then I want to make sure I don't forget to ask you about institutional investors and, you know, why they like certain types of properties over others, okay? But on the replacement cost issue, I think you are completely right. That's the same thing I was saying to my investors. In fact, I coined a new phrase for that. And I kind of try to make a distinction here between the concept of appreciation and what I call regression to replacement cost. So when you're buying below replacement cost, in other words, when it costs more to rebuild that property, in many cases a lot more, you know, then you can buy it for. You can buy it for much less than the cost of construction. I think that's a pretty safe bet. And apparently you do too. You know, do you want to just comment on my regression to replacement cost idea? Maybe, you know, to you, is that different than appreciation? I think it is. I think appreciation is when you're at, we'll call it par, where, you know, cost of replacement is equal to the cost of the property. But when it's below cost of replacement, I think that's really different than appreciation.
Yeah, I would tend to agree. I think it's important to not use that as, it has to be somewhat of an adjusted indicator, because if you have a property that's 20 years old, of course that should be below, you know, something new, because it just is not, you know, as amenitized or may not have functionality. Right. So adjusting for age is very important.
Yeah, it's not new.
And
I understand.
Right. That's just, we just feel so much safer knowing that a developer is going to have a hard time getting financed unless, and earning the economic returns to justify the risk, unless the income in that area or the rents have gone up. And so if our rents are 20 or 30% below replacement cost, and the asset value is, you know, significantly below replacement cost, that is just a very good place to be. You've hedged your risk, and the upside should kind of take care of itself with the apartments filling up, the rents growing to justify new construction. You know, by those events occurring, as I said, the appreciation should materialize.
Yep, I would agree. So let me ask you about the appetite for institutional investors. So first of all, you would consider yourself an institutional investor, right? Your company?
Yes, I would. I'd say, well, we have institutional capabilities, depth, track record, strength, but we're generally financed by private investors. So when I think of institutional investors, I think of them being, you know, getting their money from the public markets or pension funds and endowments and things like that. So just the subtle distinction there. But sophistication, yes.
Yeah, fair enough. And I sort of put it by price point, you know, amount of money. In the apartment world, you know, a lot of people on the lending side sort of consider anything over 8 million, 7, 8 million to be sort of where you get into that more institutional type stage where it's, it's not the rich guy, the millionaire next door type, right? Thomas Stanley wrote about that's buying those things. That's just too big for him. Why is it? And it's always perplexed me a little bit. I think it's just because of sort of safety and simplicity. Why is it that the institutional investors always go for these Class A types of properties with low cap rates, low yields? That's what you guys do. You do luxury apartment complexes. And, look, you're in the bastion of the Irvine Company, right? One of the biggest apartment owners in the country. And it's always, the Class A type stuff where you've got these low cap rates. Are institutional investors just not into, a little bit of handiwork, re-tenanting, raising the value? They just like that higher quality stuff always. But, it has lower yields, you must admit, right?
Right. I think it has something to do with generally the very long-term horizon that they have in terms of the money or the liabilities that they're responsible for, generating returns against. And there is a lot of historical data that shows that apartments generally offer fairly compelling returns with less volatility, and they can store their wealth in these really high-end communities that tend to generally do reasonably well over time. And so I think that the historical data tends to support that strategy for them. And they have a lot of capital to place. They like quality, right? It's just not, they're big, and they don't have a lot of time and manpower to manage these very creative, complex opportunities oftentimes. And so it really is a risk-reward, profile. So I don't know if that answered, but that's our experience.
Sure. I understand. So the demographics coming at the rental market, I mean, in my company, we like housing. The demographics coming at the rental market over the next decade are, in my opinion, pretty phenomenal. Maybe the best they've ever been in history. I mean, you've got Generation Y, the largest demographic cohort in U.S. history, slightly larger than the baby boomers by about 4 million. And the baby boomers just changed the planet. I mean, an amazing spending curve. You've got that generation is largely saddled by over $1 trillion in student loan debt that is not dischargeable in bankruptcy. They are literally debt slaves. And I have a whole philosophical opinion about that, but that's another discussion maybe. And then, they're delaying family formation. They're delaying marriage. They like mobility. As I always say, the best thing you can have on a resume is mobility, to go where the jobs are. And all those and many other factors make them kind of like ideal renters. One more factor I'll throw in, and you can comment on, is that a lot of them, they were going through their sort of formative years at a time where they saw their parents get burned in the housing market and the recession. And they're like, I don't really care about a house with a picket fence and, being tied to one location so much. I think, and also just there's it's kind of a technological component that makes people very mobile, obviously, nowadays. I mean, I can run my business from any place in the world. Just, less than a decade ago, I kind of felt like I needed a big office and a big staff and a location and a sign on the building. And I don't feel like I need that at all nowadays. And I think a lot of people are, there's a lot of mobile entrepreneurs nowadays. So those and, other factors, if you have any you'd like to add to it, I think make a pretty great opportunity for landlords, right?
Yeah. What you described is exact. I mean, I think you covered every positive characteristic that, I talk about in terms of the long wave that should be benefiting renting and landlords. I guess with the student loans, you mentioned about the debt slaves, that makes it very difficult to get mortgages. The mortgage market still is not anywhere what it was in terms of how open it is. And as you mentioned, delayed marriages. There's also an interesting, demographic or sociological statistic that there are so many more women who are graduating from college and have graduated from college than men, that there's this big educational gap, which supposedly might be contributing to delays in marriage, which is kind of an interesting thing to think about. There is the whole reurbanization phenomenon where, people want to be in these city centers, and there's a lot of, walkability, and early on, there's not much home ownership down there. And as you said, I think the return on mobility and flexibility has never been higher. It is I like to say that apartments prosper from insecure growth. In other words, the economy is growing, it's producing jobs, households are being formed, but people just feel a little bit insecure about how long they're going to be somewhere. And do they really need to be tied down? What if I have to sell in 2 years and all those transaction costs?
And all the hassle. I mean, don't underestimate the hassle. For literally almost all my life, except one portion, I was a homeowner. I owned many homes in Irvine, Newport. I lived in all those areas, right? Newport Coast, I mean to say. It's a monumental hassle to, put your house on the market, have your privacy invaded, keep it clean every day. I mean, that's a job. Living in an apartment, you just give 30 days notice and you're done. It's so easy.
It's really true. And we think about when we upgrade an apartment, we could literally have it done in 5 days or something. Imagine doing that to your house. I mean, of course it's yours and there's private ownership, but it's just so efficient too. And there's so many stories of people, right, that they took a risk with their career or starting a business because they weren't tied down by a mortgage. There's actually a line in the movie Thank You for Smoking that says, I'm just going to paraphrase, but he says something like, all problems can be traced back to having a mortgage. I mean, it was kind of a very funny line in the context, but really does tie you down. And of course it's right for certain people at their stage in life. But boy, when you're younger and you want to advance in your career and you want to show how flexible you can be, I mean, it's highly valuable to an employer.
Mm-hmm. Yeah, no question about it. Yeah. Are there any holes in my theory? See, the funny thing is, like the Thank You for Smoking line that you paraphrased, all problems stem from having a mortgage. See, I think it's great to have a mortgage on income properties that you rent to other people. But oddly, renting can be a very convenient thing for oneself. I mean, those would seem to contradict each other, but I don't think they do. I own lots of properties and I'm personally a renter. And I like that. I think it's great.
Yeah, right. I would agree with you. I think it's when you have something that limits your flexibility and the options you can have in life. And look, some people can easily handle a mortgage on their primary residence. I don't want that to apply to every single person. But the point is there's a time in your life where the last thing you want to do is limit your optionality. And mortgages on income-producing property makes sense all day long. Because the leverage and the tax benefits.
I love leverage, and I love what I call inflation-induced debt destruction, and I want to ask you your outlook, where in inflationary environments, basically the inflation pays off your debt for you. It's not only your tenants that are paying down your debt, but your inflation is. So that's a great thing too. Which leads me to another question for you. Where do you think we're going? I mean, what's your forecast for the economy? Is it, mainly on the, monetary side, inflation, deflation, stagnation, some other hybrid? What do you think?
Well, I was never in the camp, and I might have been in the minority in 2009-10 when we had trillion-dollar deficits for a few years, that was going to lead to a real spiral in inflation and higher interest rates. I felt like there was such demand destruction in the economy that actually the government had to step in and be kind of the source of demand. And it's not an ideological argument. It's just how I saw how the economy works. And so we clearly come out the other side. There's this, the global economy is so competitive. I think there was a sea change in 81, 82 when Reagan took over and the tax laws were changed, and we've become such a shareholder-focused economy and financialized economy that it tends to come at the expense of, wages and the feeling of security in one's job. And you add to that the global forces and the competition that arises there. And I look at global yields right now, and I see, Germany 10-year yields at 30 basis points or whatever, and Japan at a similar rate, Switzerland at negative rates. And we have some of the highest rates in the world, and we're seeing already what's happening to the dollar as there's, concerns or there's indications the Fed might start raising rates. And it's starting to impact our export industries. The price of oil coming down, while beneficial for some, is hurting other areas of the economy now that we've been producing so much oil. So I am still in the camp that rates are going to remain quite low for a considerable period of time. I just don't see how the Fed presses on, the brakes without doing some damage. And so, that's kind of my macro thinking right now.
So does that have to I mean, like you said at the time, it was okay to have the QE. You felt that way because the powers that be just had to step in. But I mean, do you think that ultimately that has to show up in inflationary pressure, or is it just different? Where the government can print, and the government and the Fed, I guess. It's sort of this little dynamic between the Treasury and the Fed. And they can do that without any real consequences, inflationary consequences, or does that ultimately, at some point, have to rear its ugly head, or its profitable head for investors with debt and real estate?
Right. Well, I actually talk about that fairly extensively in my book, the thinking behind why I didn't think rates were going to go higher. And I do think that people misread the situation. It does appear on the surface that it was printing money, but really all the Fed was doing an asset swap. They would press buttons on a computer, and people would sell their treasuries to the Fed, and the Fed would exchange that for cash. So suddenly you're taking interest income out of the economy. And now the people had cash, and they could do what they would with it. So it's sitting in, a lot of this money is sitting in reserves in the banking system. But the banks, the only reason they don't lend, they're not really, they would have to either be capital constrained, which they're not, they have plenty of capital now, or they really need qualified borrowers, to compensate them for the risk. And we're not seeing just a lot of demand out there for borrowing. I mean, there is in the junk bond world and all that stuff, but a lot of the capital is going to pay dividends and to buy back stock, and it's not necessarily going into the real economy. So I guess if there were profitable opportunities for businesses to really invest aggressively, and that created, now on the other hand, when they do that, that creates more supply capacity in the economy. And to me, you really start having inflation when demand far exceeds the supply capacity of the economy. And so I know I'm getting a little technical there, but I don't see it on the horizon. I think if businesses wanted to borrow more aggressively and the banks would be willing to do that, or said differently, if the banks had qualified borrowers on the consumer side and on the business side, there's plenty of capital to do that. So it's a complicated topic, but it's something I'm not really fearful of right now. And let me add one more thing as to why I believe that to be the case. The demographic structure of the developed world is really aging. And we're seeing a slowdown in labor force growth, and that is generally not an inflationary environment. If you look at how rates performed in the late 70s, early 80s, that was at the same time we had tremendous numbers of new people entering the labor force who were not very productive, and they suddenly had all of this demand in the economy, and then you overlay the oil spike with OPEC, and I just don't see a lot of those same conditions.
Yeah, interesting. Very interesting. We shall see. We shall see which way it goes. Give out your website if you would. Very interesting conversation.
Yeah, thank you. So there's two of them. The firm is cwscapital.com, and then I have a personal one, garycarmell.com, and it's got a lot of my blog. I write something every week, and And then the book is available on Amazon and Barnes & Noble, and it's, as you said, it's called The Philosophical Investor, Transforming Wisdom into Wealth.
Good stuff. Gary, I just want to ask you on that last note, when it looks like you're not fearful of inflation, at least not for a while. In terms of investor strategy related to inflation, deflation, stagnation, are you fearful of deflation?
Well, not necessarily. To me, deflation would result if you had a material depreciation of asset values, because there has been a lot of borrowing for real estate and junk bonds and to pay dividends and share buybacks. So if there was some sea change in the credit markets where suddenly these debt couldn't be repaid and the asset values dropped, that's kind of the deflation I would ultimately be fearful of. Not so much consumer prices dropping. I think they're kind of click along at maybe their 1.5%, 2.5% level. So because we're so financialized and a lot of people have their net worth tied to investments, that's the risk that I see.
So financialized, like you said, the shareholder economy. I know we have to wrap up, but I just want to let you explain that thought, if you would.
So there are businesses that are very profitable, a Qualcomm, for example, and yet they're buying back stock, they're paying dividends, they have high profit margins. Now their business is a little under pressure, and they're probably going to, restructure and lay off people in one of the more profitable businesses. And it's the activist investor. It's the pressure for high returns on capital and capital efficiency and global choices where you can put your money and hire labor and hire people. And so that is a scenario that I keep saying creates this insecure growth where, just being apartment oriented, I do think it gives people a tendency to rent for longer periods of time than they otherwise would. And I just think it reduces maybe the bargaining power that labor has, generally speaking. And so, which keeps those inflationary pressures maybe lower than they otherwise would be.
Okay, so in terms of investor strategy, I think the real estate investor, especially the one with leverage, hits a home run in an inflationary environment. I mean, that is just a home run, huge home run. In a deflationary or stagnationary environment, I think it's really just a game of yield. That's what we've seen to some extent over the past couple of years. I mean, it's sort of like we've got all these different things going on at the same time, but it's a game of yield largely. And that yield, there's just no place to get it. I mean, the real estate, the cash flowing real estate is really one of the few places you can get yield, right?
Yeah, and that's where we are probably maybe a little counterintuitive or controversial, is we have been borrowing very, very aggressively using variable rate loans. And most people that are in the real estate world, including most homeowners.
That's one where I would just think you're crazy, but go ahead and explain. Yeah.
Right. So I have a chapter in the book that says it's called Go Variable, Young Man, and all the reasons why. But in our world, there is, when you borrow at a fixed rate, it generally starts off, the fixed rate is about roughly 2 points higher than your variable rate starting off. So, of course, you are taking interest rate risk, but that 2% makes a big difference, especially if you're borrowing, $25 million like we may. But I do this on my personal investments as well, so I'm eating my own cooking. So all my personal real estate has variable rate financing on it.
Wow, you're one of the few. I mean, like nobody in the industry agrees with you on that, do they?
Right, exactly. That's right, and I kind of like that, the contrarian in me. But really, I don't want to get too technical, but in our world, when you borrow at fixed rates and you want to pay that loan off early, you often are subjected to very large prepayment penalties, because the lender wants to be compensated as if they had their money out the entire time. They don't want to get it back early. On variable rate loans, there's a very insignificant prepayment penalty. So we have a lot of optionality in terms of selling or refinancing. and a lot of our variable rate loans can be converted to fixed.
I want to make that distinction for the listeners if we could. And I own apartments and single family homes, and on large apartment loans, they very often come with big prepayment penalties. In fact, we just paid one on a deal we sold for over $8 million in Arizona. That's not the case in the typical 30-year fixed rate Fannie Mae, Freddie Mac type mortgage that a single family home or a fourplex buyer would get. So I think you do need to make that distinction. So there is some real logic behind your philosophy there. Yeah. Okay.
Yeah, sure. You're absolutely right that in the single family world, in 1 to 4 units, those you're not nearly as constrained with prepayment restrictions as we are. But what I would still say is, oftentimes, the average tenure in a home is clearly less than 30 years, and oftentimes less than 10. And so, but with that, there are other options like a 5-year fixed and then adjustable, or 7 years. So I really don't, for me, and one of the things I say in the book is I talk about courage, and courage is knowing what not to fear. And for me, I don't fear materially higher rates. We buy interest rate caps, and I feel like the positive leverage that I'm getting is worth the risk, and I can, use that excess cash flow and do other things with it. And so it is not for everybody. I do explain why it's for us in the book and our thought process, but I completely understand why we'd be in the deep minority.
Gary, very interesting discussion. I know we went a little long, but you were interesting. I hope you don't mind. And again, thank you for joining us. You gave out the websites, and we just appreciate having you on the show.
Well, thank you so much. It was my sincere pleasure.
I've never really thought of Jason as subversive, but I just found out that's what Wall Street considers him to be.
Really? Now, how is that possible at all?
Simple. Wall Street believes that real estate investors are dangerous to their schemes because the dirty truth about income property is that it actually works in real life.
I know. I mean, how many people do you know, not including insiders, who created wealth with stocks, bonds, and mutual funds? Those options are for people who only want to pretend they're getting ahead.
Stocks and other non-direct traded assets are a losing game for most people. The typical scenario is you make a little, you lose a little, and spin your wheels for decades.
That's because the corporate crooks running the stock and bond investing game will always see to it that they win. This means, unless you're one of them, you will not win.
And unluckily for Wall Street, Jason has a unique ability to make the everyday person understand investing the way it should be. He shows them a world where anything less than a 26% annual return is disappointing.
Yep, and that's why Jason offers a 1-book set on creating wealth that comes with 20 digital download audios. He shows us how we can be excited about these scary times and exploit the incredible opportunities this present economy has afforded us.
We can pick local markets untouched by the economic downturn, exploit packaged commodities investing, and achieve exceptional returns safely and securely.
I like how he teaches you how to protect the equity in your home before it disappears and how to outsource your debt obligations to the government.
And this set of advanced strategies for wealth creation is being offered for only $197.
To get your Creating Wealth Encyclopedia Book 1, complete with over 20 hours of audio, go to jasonhartman.com/store.
If you want to be able to sit back and collect checks every month, just like a banker, Jason's Creating Wealth Encyclopedia series is for you. This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.